Covered calls are one of the most fun strategies you can do in the market, and they can be an effective approach for creating income. I'm going to talk in this video about why most covered call traders lose money and how you can avoid it. Here we go.
This content is for educational purposes only and is not financial advice.
Hey everybody, it's Mark Yegi here. Hope you're doing well. And I've got 40 years of option trading experience, stock trading experience. So I'm coming from this place where I think I have seen a lot of the bodies and where they're buried. So in this video, we're going to talk about the 5 mistakes that killed covered call profits, and we'll discover a more conservative, more structured income approach. Now, covered calls can be a powerful income tool, and most traders just use them wrong. You know, they watch a video or something on YouTube, and they learn just a quick way on how to buy a stock and sell out of the money or something like that, and they don't have a full system. I'm going to cover the 5 biggest mistakes that traders make and how I use a rules-based approach to aim for more consistent cash flow. The majority of covered call traders actually underperform in the stock market, and that's not because covered calls don't work. In fact, they do work, but it's because most people don't apply structure and discipline and a system and a trading plan. So let's go through these 5 biggest mistakes so you can avoid the common pitfalls and start thinking more like a rules-based trader. Now, mistake number 1 is poor strike and expiration selection. A common mistake is picking strike prices that don't align with the market environment or your risk tolerance. Traders chase high returns. They usually choose far out of the money with tiny premiums or weekly expirations, and there's too much noise. What I do is I aim for strike prices that balance the income and probability, often slightly in the money, for more premium security. Now, the next mistake is ignoring assignment risk. Now, to me, it's not that big a deal because I like to hold things longer term, and so I roll before assignment. But some people, it becomes a big risk. And so when you sell a call, you're setting your sales price in advance. And most traders are surprised when they get assigned, and assignment is not a disaster. It's really just a planned exit. And you only sell calls that you'd be happy to sell, usually on strength, right? And so you control the outcome if you set the right strike price and you accept assignment at a profit. Assignment isn't so bad because, and remember, this is an income strategy and not a capital gain strategy. So when you get to set all those parameters in advance with your strike price, the juice, and so forth, you are setting your profit zone. And if you max out that profit zone, hey, what's wrong with that? That is a good thing. Mistake number 3 is ignoring taxes and dividends. Now, covered calls are often taxed as short-term capital gains, and that can reduce your yield by 20 to 30% if you don't plan for it properly. And if you get assigned early before a dividend, you might even lose that cash flow. Now, it's possible to trade in a tax advantage account like I do in my IRA, but I have a lot of different accounts. So sometimes the taxes apply and sometimes they don't. You have to decide what's best for you. But you need to plan your sales and your strategies around when those dividend dates are as well. I've seen traders sell covered calls every week on every stock, chasing premiums like they're candy. But more trades mean more commissions and more exposure, and volatility spikes make premiums look huge, but risk increases just as fast. I only trade when volatility and fundamentals align, and I try to go with quality over quantity. Covered calls can't save a bad investment. When a stock is tanking, you might be making some income, but at the same time, if it's tanking more than your income, you're upside down. If you're selling calls on weak or volatile names, you're stacking risk on top of risk. I try to only use high quality, institutional, consistent companies where I'd be comfortable holding the stock even if the call is an exercise. I know it's easier said than done because I've made my share of mistakes holding volatile companies. But generally, I try to get highly liquid and institutional quality companies that I can get in and out of pretty easily. So now that you know what to avoid, let's talk about the fix. The strategy that I use focuses on selling in the money covered calls. It's less exciting than chasing those out of the money home runs, but it's designed to help create more consistent risk-aware results over time. And so that's how I try to do this. I try to take a structured approach to covered calls. I try to focus on risk management. I sell in the money, and that helps me have some downside protection from the in the money, the intrinsic amount. And then I have a system for making trade adjustments. If you don't have a system for making trade adjustments, what happens in that 50% of the time when your stock is going down? You're just sitting there like a dope, hoping that it comes back up. Now, hope is not a strategy. So you have to be very proactive on your trade adjustments. And that's an important thing to learn. Selling in the money covered calls gives me higher premiums. The trade-off is limited upside, which is fine because I'm not speculating.
I'm focused on generating potential cash flow and building a more regular rules-based options process. It's about consistency in the approach for me, not excitement.
Now, in the money covered calls have a larger premium because you're getting some intrinsic value plus the juice, and you have that protection built in.
Higher option premium potential means less reliance on short-term price swings.
And that's important, especially in these volatile markets that we're having right now. And you got to accept assignment as a part of the plan. Now, you can avoid it like we talked about, but it's a part of the plan. This is my repeatable process. I try to pick strong options-friendly stocks. And step 2 is I sell in the money calls align with risk tolerance. And that protects the downside for me in a lot of cases. Step 3 is if you're assigned, recycle that capital into the next setup. And then you just rinse, repeat, and you collect the income, okay? So I start with about 10 to 15 stocks every week or so. And if the market is in the right situation, I narrow it down to only the best. And then I go through the rest of my process selling those in the money covered calls to start. Usually. Now, I teach a program called the Cash Flow Machine, which is how to create income from the stock market. And we have these cornerstones. We like to buy the right stock in the right market at the right spot on the chart, and then we squeeze the juice. That increases our probabilities of success. And covered calls are really not going to eliminate your risk. Stocks can still fall, like we talked about. Your job is to accept controlled risk while you're accepting steady income. My mindset assignments are wins. Volatility means opportunity for me in a lot of cases, and patience compounds faster than gambling. So covered calls to me are not a zero risk strategy. In fact, there are risks to them and you need to know what they are, but you also need to have a system around it to decrease your risk as well. Let's recap those mistakes that you can avoid. First of all, having the wrong strike price or the wrong expiration, pretty important. Number 2, ignoring assignment risk. Number 3 is tax and dividend inefficiency or planning. You should have a plan. Overtrading during volatility. That means you're buying back that extra theta, that extra juice. And you don't have to do that if you're trading normally. And then number 5 is poor stock selection.
For me, the solution is an in-the-money covered call approach that aims for more stability and smoother outcomes.
So if this video helped you, hit like, subscribe, and ring the bell. I've got more videos on covered call setups, portfolio management, and real trade examples from my trade. I also have a free mini course that you can go to my website and get. The description's in the link below.
There are limits to how much detail I can go into here on this platform, especially around specific trade examples. So if you want to watch longer part 2 of this video where I go deeper into the education, use the link in the description below to watch the full extended version on my website.
Plus, I have a ton of free educational content that you are going to love. So maybe I'll see you over there. If not, I have a newsletter that you can subscribe to that I'm going to get you. As soon as a video comes out, I will let you know about it, and then you can subscribe to that and you can follow me over there. Lots of different choices, but I hope to see you on the inside. Take care. By the way, before you go, can you do me a favor and click on the video on your screen right now? It helps fight the algorithm and lets me keep making these videos for you. By the way, if you want to see how this all works, I created a free mini course for you called the 4-Step Cash Flow Blueprint. Just go to this link or the one in the description and we'll deliver it right to your email. I'll see you soon.
This content is for educational purposes only and is not financial advice.